Welcome to the IVM Podcast Network.
I had a strange dream the other night. I dreamed that I died and went to heaven. At least that's what the entry gate said. There was a sign that told me, "Welcome to heaven." So I went in, and there was some sweet music at the start. And I thought, this is going to be wonderful. Maybe there will be unlimited seafood platters here. Maybe there will be slaves in silk harem pants who will hold up grapes above my face as I reclined languorously on a couch. All day long, I will get massages from voluptuous women who keep telling me how slim I am, who giggle at all my bad jokes, and flirt with me so endlessly that an accidental, non-flirtatious statement seems like downright rudeness. The music will be mellow. The saffron will be yellow. This will be heaven. Instead, imagine my shock and horror when I find that it's really a dark and dingy dungeon. There are cockroaches all over. It smells like the underperformer in the Sulabh Shauchalaya family. There is ice-cold water dripping from the ceiling. There are mosquitoes as big as frogs. There are frogs as big as cats with slimy skin that gives off mild electric shocks when they bump into you. The chairs have spikes on them. And worst of all, the music is Justin Bieber. I am in shock when I see all this. Am I really in heaven? I turn around towards the entrance and I see a babu in a safari suit wearing a badge that says, Under-Secretary, Department of Salvation. What's going on? I ask him. Am I really in heaven? Yes, he says. You are. What happened to it? I ask. He replies, We nationalized it.
Welcome to The Seen and the Unseen, our weekly podcast on economics, politics, and behavioral science. Please welcome your host, Amit Varma.
Welcome to The Seen and the Unseen. My topic for today is public sector banks. In 1969, Indira Gandhi carried out a big wave of bank nationalizations with immensely noble stated intentions. Were those bank nationalizations good for us? What were their unintended effects? Indeed, are public sector banks structurally flawed in such a way that the very concept makes no sense? To discuss all this and more, I have as my guest on the show my very good friend Kumar Anand, an economist based in Mumbai. Welcome to the show, Kumar.
Thank you for having me.
Kumar, tell me, in 1969, when Indira Gandhi carried out her wave of bank nationalizations, what were the stated intentions behind the move?
Well, the stated reasons could broadly be categorized into two of them. One was financial inclusion. So not many people had access to the institutional form of credit. So the government wanted to make those forms of credit available to people who were otherwise unbanked. And second was directing credit into areas which government thought was necessary, in which areas the credit should go.
So it was a laudable thinking that, hey, people in rural areas don't have access to bank credit and private banks won't open up there. So let's nationalize and then we can open up branches anywhere and give credit to people who otherwise wouldn't get it.
Exactly. So in hindsight, when academics have studied this phenomenon, they have said that financial inclusion and directed credit were the two main reasons. But the government's stated objective at the time itself, if you read the ordinance, when these ordinances were promulgated and banks were nationalized, the instrument through which it happened, they have said that we are basically taking these resources so that we can better plan the development of the country. And as you know, after independence, what we had done was we adopted a central planning model of development, and for that you need a lot of resources. But the problem that India faced, that we had a democracy and private properties. So you can't do the kind of planning which, for example, Soviet Russia did. So you had to do these kind of appropriations.
So in a sense, it's just as Nehru made the mistake of thinking, India needs to be a planned economy, and not realizing that economies grow by themselves and the government should just essentially stay out of the way and maintain the rule of law. And Indira took it one step forward by saying that, hey, we need more resources to control and plan the economy, so we will take it from the private sector.
Yeah, in a way, we were not learning the lessons. So, for example, the planning entire thing started in 1950, and during the time, we nationalized. In the decade of 1950, we nationalized transportation, we nationalized mining, we nationalized parts of insurance corporations, and but always the reason of not getting the right result from the planning was given that we don't have enough resources. So you kept on trying to get more and more resources. And it was in that same vent and, spirit that we nationalized bank in 69 and then again in 80.
Now, tell me something. It's one of the interesting things about the nationalizations of 69 and all of the other similar measures that Indira carried out were that despite the economic reasoning given, which you just laid out, there was also a political backdrop to it. Can you tell me a little bit about that political backdrop?
The little political backdrop could broadly be, I think, framed in terms of that all major political parties and the entire rhetoric at the time was extremely interventionist in nature. So no matter all the mainstream parties were different shades of, you could say, interventionism. With the sole exception of Swatantra, which was... Yeah, which died soon after. Mm. So what they were trying to do is they were trying to outdo each other. So you want to appear more pro-poor, so you have to go and take away properties of people who are otherwise rich. So bankers, insurance people who run insurance companies, you take away those properties and say that, yes, we are doing it for poor and we are directing resources so that in future probably India will develop. Very intuitive zero-sum thinking, in other words. And the interesting immediate backdrop is that Indira Gandhi was this is when the Congress kind of broke into two, Congress I and Congress O. And for Indira, because the other faction of the Congress was were leaders who had lived through the narrow years but kind of learned from the mistakes and were trying for a course correction, the only way for Indira to differentiate herself was to go further leftward. And this kind of pro-poor rhetoric, though these actions of course harm the poor the most, but the rhetoric is pro-poor, was a very good way of setting her brand apart. Garibi Hatao, Indira is India and so on. So tell me something, just going back to the seen objectives. Before we get to the unseen effects, to what extent were even those seen objectives attained? Well, frankly speaking, not much. And when you nationalize these banks, and so as I was mentioning, the first tranche was done in 1969 when you nationalized 14 banks, and then again in 1980 when you nationalized 6 more. So what you had was majority of the banking was all publicly owned, all owned by the government of India. So you couldn't say that you don't have basically a counterfactual. So you can't say if there was a private sector bank, what would have happened? Because all banking in India at the time was all owned by the government and run by them. So both the objectives of financial inclusion and directed credit, in hindsight, people have studied this. In 2008, I think Planning Commission set up a committee under the chairmanship of Raghuram Rajan, and he studied public sector banking in a little bit detail, did some studies on, ran some numbers, and judged the effectiveness of public sector banking having existed for now about 30-40 years, what were the success. And on both the measures, it turned out that they had not done really well. So just to quickly tell you about a few of them. So take, for example, financial inclusion. On financial inclusion, the committee found that poor in richly branched urban areas have no more access than in poor in rural areas. So the problem of financial inclusion is not so much about availability of branches, but rather poverty itself. Right. Yeah. Second, for example, could be that they found that no systematic relationship existed between regional credit disbursement and the presence of public sector bank. Then they also found that in rural areas where private banks are present, they don't discriminate against the poor. So at the end of the day, it's business for them. So and Rajan in fact has concluded that the kind of environment you want to build is where you compete for the poor. Now, when you look at the other objective, which was directed credit, in recent years, we have seen that private banks have done better than public sector banking in achieving the priority sector lending criteria. Just to give you a quick background, the priority sector lending is something that RBI mandates that every commercial bank in India, private or public, will have to lend 40 rupees out of every 100 rupees that they lend out to priority sectors, which are agriculture, micro, small and medium enterprises, etc., etc. So in those areas, the committee found that the private sector banks have done a much better job than a public sector bank. Then again, coming back to the same directed credit, they also found that in terms of loan timing, in times of drought in a district, private banks appear to provide more agricultural loans, while public sector banks provide more consumption loans. Again, in long term, which is harmful. And when it comes to quality of directed lending, the share of NPAs in the PSL has been higher for public sector banks.
Yeah, and the greater efficiency and the higher quality that the private banks provide is, of course, because of the incentives involved, which we'll come to later. But I just wanted to point out this funny mishearing that when you spoke about the Raghuram Rajan committee, you said the ransom numbers, and I heard that as ransom numbers, which is sort of an appropriate mishearing. Now, let's get to the crux of the matter. Before we even get to the unseen effects are really a consequence of the incentives in play. How the incentives are different in public sector banks from private sector banks. Can you elaborate a little bit on that?
So if you think about it, think of any government enterprise. Right now we are discussing public sector banks, but that is true for almost any other enterprise. So when you're running an enterprise, what is your objective? If it is a private enterprise, the objective is profit maximization. Now, I should forewarn that the government and the public sector banks themselves, they know that the profit maximization is not their goal. So their goal is financial inclusion and directed credit, and we just saw that, they have not been able to successfully achieve those credit. Now, the incentive, the way it works for public sector bank is that people who work there, their jobs are tenured. They don't have too much of, they have complete job security. So no matter what, mishap happens, their jobs are guaranteed. They don't have any incentive or disincentive because if they do a good job, they're not going to get a great pay hike, or if they do a bad job, they're not going to get a rap on the knuckles.
So essentially, what is true of all government, what is true of public sector banks, therefore, also is what Friedman mentioned in his 4 ways of spending, which is Friedman's law of spending, rather. So there are 4 ways in which you can spend money. One, you can spend your own money on yourself, when you obviously try to maximize value because you're spending it on yourself, but you also want to economize because it's your own money. The other is when you spend your money on someone else, when you want to economize, but you don't care so much about value because it's going to someone else. The third is when you spend someone else's money on yourself, when you want value, but you don't really care about economizing because it's someone else's money. Such as, for example, if you work in a company and they send you on a foreign trip and you'll be ordering whatever you want in room service because that's taken care of by the company. And the fourth way is when you spend somebody else's money on somebody else, where you don't care about value and you don't care about economizing. It's not your money, you're not spending it on anyone else, and that is all of government. And to add to that, this is the fact that all of government is therefore also tenured. So even those incentives aren't there. It's just their incentives revolve around how they can use their power for personal benefit. And that is something that is a problem with any public sector enterprise, especially public sector banks, and one reason why they haven't achieved their objectives.
Yeah, in a way you could say, yeah, that's true. That's correct.
So getting to the crux of the matter, the unseen effects. Can you elaborate on some of the unseen effects that come from these perverse incentives?
Sure. There are too many, but we'll limit ourselves to a few of them. First, you can directly look at what are the direct costs in terms of, so these banks have to regularly go for recapitalization, and because it's government owned, so the liability lies on the government and government has to finance it. That means we taxpayers have to pay for it.
Right.
And some of the data that we had collected some time ago, we found that so in about 30 years from 1985-86 onwards till now, the amount of money that taxpayers had to pay is 1,47,000 crore for the recapitalization of banks. Now imagine the direct cost which we incur for maintaining these banks, all those alternate usage that these money could have been used for. We know that our criminal justice system is so poorly staffed in terms of policemen and the number of judges you can hire. So 1,47,000 crore is a lot of money. So of course one is the direct cost itself. Then this also promotes inefficiency in the entire banking system. So for example, the people, as we were just discussing, the people who run this, they don't have the skin in the game, So think of the example like Maruti when it comes to car industry and Bajaj when it comes to scooters. So you didn't see much of, or BSNL or MTNL when it came to telephone. So you didn't see much of technological advancement when it was happening, when they had sort of almost a monopoly on these sectors. So similarly, the same is true with banks. So for a longest period, you didn't see any advancement. And even today, public sector bank almost always one step behind the advancement that the private sector banks have done. many of the public sector banks, I know they struggle with running our ATMs. The internet banking is crashed. They don't run very efficiently.
In fact, just to take this point forward about inclusion, and you mentioned the telephones, and I'm glad you do so. And like I grew up in the 80s where we had one government telecom provider, which was MTNL, and we had one airline, which was Air India/Indian Airlines for domestic and foreign. And what you found was, now I was from a privileged family, we had phones at home, but otherwise if you applied for a phone, you had to, there were 5-year waiting periods and so on. Right. Massive scarcity, not just technology, just basic scarcity. And similarly with airlines, only very, very rich people could use them. Even the common middle class guy couldn't dream of flying. It was like a very big deal at the time. And what happened is, the moment the government opened it up because of competition, inclusion happened. Right? Today, anybody can buy a phone. Today, your maidservant who comes home has a phone which can do so much more than the most advanced technology of those times. And today, far more people fly than back in the day. It's become much more commonplace. So the best way of increasing inclusion in these specific sectors was simply opening it up. And today, therefore, MTNL seems irrelevant, Air India seems irrelevant, and hopefully won't exist for too long as a government-owned company. And why doesn't the same logic apply to banking?
Well, that is a question which has been, unfortunately, not even been asked. So whether it comes to academicians, they think this as a political economy problem, this is unsolvable. So they just can't touch it. Raghuram Rajan committee report, when it was giving its recommendation, it falls short of suggesting privatization of the banks. The most recent example is in 2014, I think it was RBI which constituted a PJ9 committee report, and I think they are the ones who delved very deeply into the governance of public sector banks. And they also almost, have explicitly said that we can't consider almost privatization of banks. So their entire set of recommendations just veered around what all they can do within the current system, current governance. So
essentially
structure.
They'll identify...
It's become sort of a holy cow.
So they'll identify the problem correctly and they know what's wrong with it, but they just stop short of suggesting the correct solution, even though they know it. Is that because of pressures in the political economy per se?
I don't know. Maybe it could be just be that they see this as a holy cow.
Yeah.
While at some point of time, one of these guys have also mentioned that the RBI has mandated private sector lending, which should achieve the objective of the government. So no matter whether you are ICICI Bank or a State Bank of India, you have to give certain amount of credit. So in this case, 40% and 80% of that goes to agriculture, directly to, the credit disbursement should go into these areas. So it should not matter. I mean, you have already mandated. Right. So whether it is State Bank of India tomorrow gets privatized, they will still have to abide by those rules.
And there are arguments against such mandates also, but be that as it may, if you have the mandate, you don't need the public sector banks because your purpose is achieved and it's achieved better and more efficiently.
Absolutely.
But I'm sorry, I interrupted you and set you off on this digression. So the first two unseen effects you mentioned were, one, when banks get recapitalized, it basically comes from taxpayers' money, which is us, and you mentioned the humongous amount of money spent on that.
Only in the last 3 years, it was 50,000 crores. The last 3 years has been, including this year, this financial year, it is 50,000 crores.
See, these figures don't mean a thing to me because I can't comprehend 50,000 crores. I can comprehend 50,000 or even 50 crores. What is 50,000 crores? I mean, if you stacked up 10 rupee coins, you'd probably get from here to the moon. I'm guessing.
Think so, probably.
Yeah, or maybe not, whatever. We leave it to someone else to calculate.
If you take a different currency, probably Mars even. I don't know.
Yeah, I mean, Zimbabwe currency you can just get out of the Milky Way. Right, so the two unseen effects, I apologize, you mentioned were direct, the fact that the recapitalization expenses are basically borne by us, and you've demonstrated how that's happened through the years, 50,000 crores over the last 3 years. And the second is that there's inefficiency because of incentives, because the bureaucrats who run the banks have no skin in the game, as you put it, and therefore they don't really, why should they do a good job? What else?
So we have been listening recently a lot about NPAs. So you could say that even rising NPAs is a part of that. Now, how does that happen? So imagine a world where you have a monopoly over giving out banking service. And today, almost about 70% of the banking business is done by public sector banks. In many areas, they are the only banks operating. So if you want a loan, you have to go to that neighborhood bank, which is owned by the government. And the guy sitting there at the head of the table who has to sign your loan and award that loan to you has this arbitrary power. And you can't turn to someone else. The local moneylender you will go to will probably charge you 40% or maybe even more. So you know that in this case, you are stuck with that. So what this does is, this becomes a case of corruption then. So the arbitrary power, which is now lies in the hands of monopoly in a way which has been existed for a long time, and the incentives, the way we discussed. So this, in a way, breeds corruption. It becomes a breeding ground for corruption. Outside of that, it becomes, think about when we're talking about NPAs, a direct and obvious consequence of all this is a higher NPAs. There's no need to or incentive for the PSB employee to do a thorough check of a prospective borrower. So if I go and want a loan for about 1 crore rupees to buy a house from ICICI Bank, the guy who is going to award me that loan is going to be very thorough with this. But if he's going to look into my credit history, whether I have paid back loans in the past on time or not. Now there are agencies which are doing this kind of reporting and background checks for you. But not necessarily those kind of incentive exist for public sector bank. And therefore you will see that the NPAs are for the public sector bank are almost always higher than for those for private sector banks.
In fact, the opposite incentives exist because often if powerful politicians say ki bhai isko loan do aur usko loan do, they don't really have an option but to agree. The columnist Vivek Kaul wrote an interesting piece on the site that I edit, Pragati at thinkpragati.com. The name of the piece is called The Separation of Knowledge and Power. And he gave some great figures in there. Now consider these. In the SBI, their bad loans ratio of the bank when it came to home loans was 0.43%. When it came to auto loans, it was 0.65%. For overall retail loans, it was 0.55%. But Vivek's piece reveals, for large corporates, it's 9.67%. For mid-corporates, it's 19.35%. For small and medium enterprises, it's 7.04%, which means 10 to 20 times as much as for auto loans or retail loans, and far, far more than the NPAs of private sector banks. And the reason for this is essentially that politician tells you ki bhai isko do, you have to, and you don't, like another interesting figure he points out is he refers to a specific loan where a public sector bank gave a loan at a debt to equity ratio of 14.6 to 1. While no private sector bank will ever give a similar loan at a debt to equity ratio more than 2 to 1. And this is 14.6 to 1, this specific loan that he talks about, which is obviously political pressure and is deeply irresponsible. And that is why we have such a massive NPA problem in the country today.
This also brings me to another unseen effect of the ownership of government banks, is that it creates an uneven playing field in the market. So there is sort of sovereign guarantee which lies behind all these public sector banks, which have been created by an almost act of parliament. So you won't see even their name appear in the other public sector enterprises. So there is a sovereign guarantee which these public sector banks enjoy, which a private sector bank does not enjoy. So a public sector bank can never go bust, that means, because they have the taxpayers always standing behind to bail them out.
So essentially, if a public sector bank gives a loan to someone for 70,000 crores and that person defaults, hey, no sweat because the taxpayer pays for it, right? Whereas with the private sector bank, the taxpayer doesn't pay for it. The bank can go bust. It's the bank's responsibility, and therefore the incentives are much better within the organization to prevent that kind of occurrence.
Exactly. And this prevents from a robust market to develop for banking, because it depresses the private sector bank's competitiveness to compete. And even then you will find it, our private sector banks have done excellently well by grabbing almost more than 30% of the market share from the time they were allowed to come into, and start being in the business of banking. But
there's an argument that the counterfactual is that the banking sector would be far more developed if public sector banks simply didn't exist. Because what public sector banks also do, as you pointed out in our conversation with me earlier, is that they create an uneven playing field which stops private sector banks from growing.
Exactly. Then there are some of the other unseen effects of public sector banks are that it depresses the growth in the economy. So when the flow of credit is determined arbitrarily by the government or bureaucrat and not by the profitability or viability of a business, what happens then? More often than not, the hard-earned savings which a banking institution is supposed to channelize into other productive uses now gets channelized into non-productive uses. That's why the higher NPAs and etc. So you see that the otherwise growth of the economy would have been much higher than what we see now, which also causes less jobs to be created and other
exactly. So in a proper free market where failing companies are allowed to fail and where everything adjusts for supply and demand, the money would go where the money is needed the most. And that is something that government, with its fatal conceit of central planning, simply cannot manage.
Right. Then another unseen effect is the damage it does to the fiscal consolidation. So we have something called FRBM Act, Fiscal Responsibility and Budget Management Act, where the government of India has put a constraint on itself saying that we will abide by these rules and not spend more than, say, a certain amount of money, in this case being more than 3% of GDP as fiscal deficit. So they won't cross that. But from the time of financial crisis, they have always been breaching that number. They have never gotten back to it. And sovereign credit rating agencies, when they come and rate India, they have always reprimanded in a way the government, saying that, you guys have been very profligate, particularly when it comes to banking and not being able to control your NPAs. And therefore, it prevents India from getting a good rating. And when you don't get a good rating, that means the cost of borrowing for the entire economy goes up. So any business, when they go out of India, try to borrow money, the cost of borrowing for it goes up. And similarly for India itself, the sovereign bonds that the government of India will issue, it will be able to raise funds at a higher rate from foreign borrowers.
So the ripple effects of that essentially go far, far beyond the taxes that we pay or our taxpayers' money going into capitalizing these banks. So go into the whole economy being curtailed as a result of all of this. You mentioned the financial crisis, so I want to ask you a question here, which a lot of people speaking in favor of public sector banks often say that, look, we didn't suffer so badly from the 2008 financial crisis because so much of our banking was public sector and blah, 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 and this is the way the system is, and it's a good thing. What's your response to that?
Definitely not. So imagine a guy who is living in a jungle of, say, central India, in somewhere in, it could be Chhattisgarh or Jharkhand. When the crisis hit, he was not affected at all. The same analogy can be used for India. So if you are not integrated with the world economy and a crisis is hit, and if you don't say that, I didn't get hurt because I was able to regulate my banking system very well, is not a very good argument to make, because you also lost quite a lot. Had you been integrated into the global economy, you would have been able to have access to these sources of finance. You would have been able to make kind of investments which you were never able to do, etc., etc. So the opportunity cost is very high that way.
In other words, what you're saying is that if we were integrated into the world economy, the gains from that would have been so much over the years that even if we suffered more in percentage loss terms because of the financial crisis, we would still overall be far better off than what we were.
Definitely. I mean, look at just the per capita income of the countries which suffered and per capita income of India. They are, even after the crisis, they are much better off than we are today.
So in a sense, it's not a feature, it's a bug.
You could say that, yeah. But I'll also say that public sector banks are not exactly completely the culprits here. In a way, they are also victims. Let me explain that a bit. So public sector banks have to go through dual regulation. So on the one hand, RBI regulates them like every other commercial bank, private banks, while Ministry of Finance also regulates them. Number two is that the poor pay compared to, a private sector bank. So which we have discussed briefly in the beginning, that there is no way, because of these written rules and which cannot be changed without permission from, say, Ministry of Finance or a finance minister or somewhere at that level, you cannot, get good talent through which you can probably do a better business. Then there is external vigilance enforcement through Chief Vigilance Commissioner or CBI, which are mandated to look into the workings and the dealings of public sector bank. In certain cases, public sector banks are also open to RTI inquiries. So what happens is that the incentive that the banker has, knowing that he is going to be publicly scrutinized for all these from all these various agencies, is to play a little more safe and not trying to take kind of risks that otherwise a private banker would do and therefore increase. And these are some of the reasons probably through which a public sector bank should be on par and play with a private sector bank.
On the same playing field.
It should be freed up basically and try and let them operate like a private sector bank. So and that can happen through making them like privatizing them.
So in a sense, this is like the flip side of the NPA problem. The NPA problem is that you're forced by political pressure to give out loans to people which you know are bad loans that are never coming back. And the flip side of that is that when it comes to giving out loans, because you know that every action of yours will be scrutinized, you are inclined and incentivized indeed to just play it completely safe. And whereas with a private sector bank, there's a healthy amount of risk that you have to take on with due diligence, of course, which public sector bank employees, because they're not being rated on performance per se, just want to cover their asses, except when order comes from Netaji.
Right, exactly.
Kumar, it's been a pleasure having you on the show. Thanks so much.
Thank you very much.
And that's all we have for today. I'll see you next week, but if you just can't resist having more of me, you can follow me on Twitter at Amit Varma. That's AMITVARMA. You can also head on over to my blog, India Uncut, at indiauncut.com. And if you want to binge listen to past episodes of The Seen and the Unseen, and who can blame you for that, head on over to seenunseen.in. If you enjoyed listening to The Seen and the Unseen, check out another hit show from IndusVox Media Networks, Cyrus Says, which is hosted by my old colleague from MTV, Cyrus Brocha. You can download it on any podcasting network.
Excuse me भैया, excuse me.
बोलिए मैडम.
मेन्यू में क्या है?
मेन्यू में सीन अनसीन है, पॉडकास्ट है, ऑन कोर्स है, साइरस है, मेड इन इंडिया, रीडिस्कवरी प्रोजेक्ट, एम्पावरिंग सीरीज, सेक्स वैक्स है, IVM लाइक्स है, सिंप्लीफाइड है, कीपिंग इट क्वियर है, थिंग्स एंड डेस्टिनेशंस है, माय नेबर सकरबर्ग है और द फैन गराज है. आपको क्या चाहिए?
एक बार रिपीट कर देंगे क्या?
रिपीट नहीं करता हम. आप जाओ IVMpodcast.com पे और सुनो ये सब, या फिर डाउनलोड करो उनका ऐप. सब आपकी उंगलियों पे.